In this video, I'll talk about choosing the best leverage to trade Forex. Um, this is one of those situations where there is no real right answer. And the reason I say that is, let's say that you have a net worth of $1 million and you have a play account in the Forex market and that account's $5,000. Well, do you really care? I shouldn't say, do you care that you lose $5,000, but it's not going to cause major problems. So, with that being the case, at that point in time, you can do whatever you want. But for most of us, we have a Forex account that may very well be a substantial part of our portfolio. And as a result, the losses really hurt. So there are a lot of schools of thought. There is the 1% to 2% rule. That's the most common thing you'll hear. I will tell you this, though, that I think is a bit of misnomer simply because when they say that, they're generally talking about position trades. So, I have the New Zealand dollar, Japanese yen daily. Had you taken this candlestick down here and a break of it as a buying opportunity, you might risk 1% and you hang on. The problem you run into with 1% being risked on a shorter time frame, so you trade the 15-minute chart, a spike like this will take 1% out rather quickly. Now, having said that, 1% isn't a ton of your account, but you'd be surprised at what most professional traders on prop desks, they're normally trading 0.1, 0.2%. And the reason they do that is it kills the monster while it's little. Your losses are not something to be overly concerned about. Furthermore, if you take one of these trades and you do a 3-to-1 risk to reward ratio, well, 0.6% is a good return on the day. I know it doesn't sound like much, and I understand that if you have a small account, that could very well not be much. On a $1,000 account, that's not going to make a significant difference in your life. But as you build it up over time, it will. Something that I would point you to is prop shops. You can trade for a proprietary firm if you can pass tests. A lot of times you'll see they'll have like a relative drawdown of 4%. And it teaches you to protect trading capital, which is by far the most important thing to do. One of the biggest problems that we have in the Forex world is all of the flat out lies being told about the returns. Some of the best Forex traders in the world, and we're talking about the absolute elite on their best years, make 60%. On a $1,000 account, that's $600. So that's why I would encourage you, if you are a profitable trader, to look for more capital to trade. That being said, if you do come up with a nice track record, quite often, something like 2% a month, 3% a month, something like that, you can start to show that record to various shops around the world, firms that will actually back you, and you'll be trading much larger accounts. You have to think of this through a career prism. Now, if you have a sizable account that you're trying to build up, then fine, 1% makes sense. But, this is one of those deals where, again, maybe you have $100,000 in your account. That's still a $1,000 loss. Now, one test from a psychological standpoint that you can do, and this will make a huge difference, is put on a position, whatever the size may be, and then gauge whether or not you can stand the thought of it running while you're not at your desk. So, as you go on about your day, are you comfortable with the idea of being long a particular asset or a particular, um, currency? If you put this on, and let's just say okay, I'm going to do 0.5% risk, and you take that trade. Now, if you find yourself going on about your day, not overly concerned, that is risk that you're comfortable with. Because one of the hidden problems is, you get these guys out there that'll put 5% on, and they have to watch the computer every minute. And what will happen is you see a little bit of a pullback, they'll freak out, they'll close out the position, and it will go higher anyways. So it's part psychology, and then it's just part math. You start losing 5% at a time, it's a major problem. Another thing that and I'll leave you with this point, and I'm going to use 100. Let's just say you have a $100 account and you lose 10%, because I have seen the number 10% thrown around quite a bit, right? So now you have $90. Well, this $90 account, in order to get back just to $100, is 11%. So you risk 10%, you lose that, now you need to get 11%. And actually, it's a little bit higher than that, because $9 is 10% and 11%, so it's like 11.1%. So keep that in mind. That's the problem with leverage and the percentage and compound interest. It works against you when you start losing. So that's why you need to kill the monster while it's small. I would recommend starting out with 0.1% and working your way up until whatever your comfort level is, from a psychological standpoint. And then open up an Excel spreadsheet and look at what the compounding damage can do. 4 losses in a row. See what kind of damage that does to your account at the level you're trading. You'll probably find that somewhere in the middle of all of this is the optimal mathematical solution. So again, there's no real one size fits all on this, but there are a lot of things to think about.